A few months ago, many Americans expected interest rates to start coming down. Mortgages were supposed to get a little easier. Car loans were supposed to get cheaper. Credit card pressure was supposed to cool. But that relief keeps getting delayed. The Federal Reserve is still waiting. Wall Street keeps pushing back its rate cut forecasts, and Americans are left dealing with expensive borrowing for longer than expected. In this video, we'll break down why inflation still isn't low enough for the Fed, how energy prices change the rate cut story, why the job market gives the Fed room to wait, what experts are now predicting, and what all of this means for Americans dealing with housing, debt, jobs, and the possibility that cheap money may not return anytime soon. The Fed's basic problem is simple. Inflation has improved, but it is still above the Fed's comfort zone. The Fed wants inflation around 2%. But the latest PCE inflation reading, which is one of the Fed's preferred measures, rose 3.5% from a year earlier in March. Core PCE, which removes food and energy, rose 3.2%. That means prices are not rising as fast as they were during the worst part of the inflation surge. But they are still rising too quickly. The Fed does not need perfect inflation before cutting rates, but it needs confidence that inflation is clearly moving back toward 2%. Right now, that confidence is not there. One big reason is energy. Higher oil and gas prices make inflation harder to control because they show up quickly in transportation, shipping, groceries, travel, and consumer expectations. Reuters reported that UBS delayed its forecast for Fed rate cuts because of persistent inflation and a resilient job market. UBS now expects cuts in December 2026 and March 2027 instead of earlier in 2026. The same report noted that energy costs were responsible for more than 40% of the recent rise in consumer inflation. That is the key issue. Even if some parts of inflation are cooling, an energy shock can restart pressure across the economy. For the Fed, cutting rates into that environment would be risky. The Fed would be under more pressure to cut if the labor market were clearly weakening, but so far, the job market is not weak enough to force action. Reuters reported that U.S. employment increased more than expected in April, while the unemployment rate held steady at 4.3%. That gives the Fed room to keep rates steady while it waits for inflation to cool. The interpretation is straightforward. If people are still employed and the economy is still holding up, the Fed does not feel forced to cut. It can wait. That is frustrating for borrowers, but from the Fed's perspective, it is safer than cutting too soon and letting inflation come back. At the start of the year, markets expected rate cuts. Now many experts are changing their forecasts. Barclays recently became the latest major brokerage to predict no Fed rate cuts in 2026, moving its expected first cut to March 2027. Reuters also reported that traders saw roughly a 78.7% chance that rates would stay steady through the end of 2026. Boston Fed President Susan Collins also warned that rate hikes may be needed if inflation remains high, even though that is not her base case. Her point was that the Fed may need to stay slightly restrictive until inflation is clearly under control. So the expert message is shifting from cuts are coming soon to rates may stay higher longer. For Americans, this mostly shows up in three places: housing, debt, and jobs. Housing stays expensive because mortgage rates remain elevated. Even if home prices stop rising, monthly payments are still painful when rates are high. Credit card and auto loan costs also stay high. That matters especially for younger Americans who are already dealing with rent, student loans, childcare, or car payments. The job market is the slower moving risk. If rates stay high long enough, businesses may become more cautious. They may delay hiring, reduce expansion plans, or slow wage growth. So the issue is not just that rates are high today. The bigger issue is that high rates are lasting long enough to change household decisions. The big question is no longer just, when will the Fed cut? The better question is, what if borrowing does not get cheap again anytime soon? The economy Americans got used to after financial crisis was built on low rates, cheap mortgages, and easy credit. Today's environment looks different. Inflation is more unstable, energy shocks are harder to ignore, and the Fed is more cautious. So for Americans, the message is clear. Rate relief may still come, but probably not as quickly as people hoped. Until then, housing stays difficult, debt stays expensive, and the economy keeps adjusting to a world where cheap money is no longer guaranteed.